Welcome to Let Me Break It Down, the channel where complex ideas become simple through visual storytelling. Whatever it is, we're here to break it down one idea at a time. So let's say you've been working hard, you've saved up, and boom, you finally have your very first $1,000 ready to go into the stock market. You're completely ready to make your money work for you. But almost immediately, you hit a wall. This right here is the ultimate beginner's dilemma, right? With $1,000, do you just go all in on one incredible company? Or do you spread that money around and diversify? Or, hey, maybe $1,000 is just too small to even worry about diversifying in the first place. Well, we're not going to just give you the classic "it depends" answer. We're going to break down exactly what makes the most sense for you when you're just starting out. Let's jump straight into part one, the illusion of diversification. Okay, before we even talk about what to buy, we really need to look at risk. And a lot of people fall into this super common trap, what I call fake diversification. They think just owning a bunch of different stocks automatically means they're safe. Like imagine you buy Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla. That's 7 massive companies. You might look at that and think, wow, I am incredibly diversified. But are you? Actually, no. Think about it. They're all giant US tech companies. They ride the exact same economic waves and get hit by the exact same trends. If the tech sector takes a hit, your whole portfolio goes down with it. You own a lot of companies, sure, but they all share the exact same risks. That is fake diversification. True diversification isn't just about counting how many stocks you own. It's about owning investments that don't all move up or down for the exact same reason. It is a completely deliberate strategy. You want to build a basket of assets that won't just get entirely wiped out by one single piece of bad news. You need balance. So, bringing it back to our $1,000, should you diversify it? The short answer is absolutely yes, especially as a beginner. But the reason why, well, it might actually surprise you. Which brings us to section 2, the emotional toll. Believe it or not, the absolute biggest risk when you're just starting out isn't picking the wrong company. It's making a highly emotional decision when things go south. Let's look at a really common scenario. Say you go the go big or go home route. You dump your entire $1,000 into one stock. You're feeling confident. But then, a few months later, they put out a terrible earnings report. The market freaks out, and just like that, the stock plunges 30% in a matter of days. In the blink of an eye, your $1,000 shrinks down to $700. How would you actually react in that moment? With your real, hard-earned money on the line, do you calmly hold on, trusting your research? Or do you panic and hit the sell button just to stop the bleeding? Listen, almost everyone finds out the hard way that their risk tolerance is way, way lower than they thought once real money is actually vanishing. And you know what? That is completely normal. Investing isn't just numbers on a screen, it's a massive emotional roller coaster. Any seasoned investor will warn you about this. When you watch 30% of your savings evaporate, logic just kind of flies right out the window, and that usually leads to panic selling at a massive loss. So, how do we fix this? Let's look at section 3, the variety pack solution. To avoid that horrible feeling in your stomach, you need an alternative to betting it all on black. Instead of picking one company, you can actually just buy the entire market. This is where index funds and ETFs come in, and they are incredibly popular for a very good reason. If you buy an S&P 500 ETF, you're basically buying a tiny slice of roughly 500 of the biggest, most successful publicly traded companies in the US, all at once. Think of it like a giant variety pack. If one company in your basket has a terrible year, it's not the end of the world because another company in that exact same basket might be having a record-breaking year and totally counterbalance that loss. It's just a remarkably successful, time-tested strategy for long-term growth. But we need to talk about section 4, the cost of safety. Now, as your guide here, I've got to be totally honest with you. This safety is not free. There's a trade-off that people don't talk about enough. Let's run the math. If you put your whole $1,000 into one single stock and it doubles in price, 100% gain, you just made a massive $1,000 profit. Awesome. But in a heavily diversified ETF, that exact same blockbuster stock might only make up, say, 2% of your whole portfolio. That means out of your $1,000, only $20 is actually invested in that specific company. So when it doubles, you only make $20. It's definitely not a life-changing win. That is the literal cost of safety. It protects your downside, sure, but it mathematically limits your chances of an overnight, extraordinary gain. It really just comes down to what you're prioritizing. So what is the smartest, most practical move for a beginner today? Honestly, unless you have the time to sit and study financial statements all day, you are at a huge disadvantage against the pros. The absolute best move is keeping it incredibly simple. A perfect example is a low-cost S&P 500 ETF like Vanguard's VOO or SPY. They essentially do the exact same thing. They buy the S&P 500. But VOO is super popular because it has a crazy low expense ratio of just 0.03%. That basically means the management fees eating into your money are kept to the absolute bare minimum while you hold that awesome variety pack. Moving on to Section 5, Actionable Steps for Limited Funds. Okay, so this brings up a real logistical hurdle. Let's say one share of an ETF like VOO costs somewhere around $700. If you only have a $1,000 budget, what exactly do you do with the rest of your cash? You definitely don't want to just buy random cheap penny stocks. You have two really straightforward options here. Option 1, you buy your one share for $700, keep the remaining $300 in cash, wait until you've saved up a bit more, and then buy your second full share. Or option 2, and this is so accessible today, you use a brokerage that allows for fractional shares. This means you can just invest your exact dollar amount. You could buy, 1.4 shares right out of the gate, making sure every single one of those $1,000 is actively working for you in the market from day one. And finally, Section 6, Building Wealth Through Habits. Before we wrap up, we really need to talk about this sort of quiet embarrassment a lot of beginners feel. This idea that $1,000 is just too small to even matter in the grand scheme of the stock market. We need to completely flip that mindset. Having a small starting balance is actually a massive advantage. Here is the undeniable truth. You're going to make mistakes. Every single successful investor makes mistakes, but it is so much better to make those emotional rookie mistakes now, when your account is small, rather than learning those painful lessons later when you've got hundreds of thousands of dollars on the line. You really have to embrace this. Your first $1,000 is probably not going to make you rich, but the habits you build with that $1,000, that is absolutely what will make you wealthy. It is entirely about just getting started today, even if it's literally just $100. It's about opening the account, setting up that regular automatic transfer, and proving to yourself that you can stick to a plan over the long haul. Once you build that rock-solid habit of consistent, patient investing, you just step back. You let your account grow, and you let compound interest do all the heavy lifting for you. So the real question you need to ask yourself isn't whether $1,000 is enough to make you rich today. It's whether you're ready to build the habits today that will make you wealthy tomorrow. Thanks for watching Let Me Break It Down. If you enjoyed this breakdown and want more visual explanations of the world's most interesting ideas, subscribe and join us for the next episode. Until then, stay curious, and we'll break it down.